profiles, how you can see, where you can understand what is the basic net profiles and all. So these dark lines which you are seeing are your payoff profiles, okay? And the lighter ones are the immediate profiles. And this one, dark lines at the expiry, what would be your payoff profiles? And the thin lines which you see are this. And this left side y-axis is the payoff, and the x-axis is the spot price. You know, spot prices from here, it's like 8,000, 8,500, everything. You from here to here, you put all the spot prices. Okay. So at expiry, what will happen? It will show. So this is the premium amount that you have paid already. The maximum loss that you can have on a long call is this is the premium that you paid. And when they say unlimited profit is there. But can you think a Nifty can go from 8,000 to 45,000 this month? It will not go, right? Hello?
Yeah, no, it will not go.
Yeah. No, so the boundaries are maximum amount of Nifty that you can go. If it is Nifty, this is a Nifty long call. So that there is a boundary defined for you. It is a strike price that it is there for you, and even your strike prices are not more than 11,000 or 12,000, or I don't know what is the strike price we have. The maximum strike prices that we can go ahead and people can buy or sell or whatever. That is the maximum that you have. So your boundary conditions are defined by your maximum strike price, and your break even. Whenever you go to this value, this is the break even. You neither earn money nor gain. And anytime the strike price is more, your current market price is increasing more and more, then you are getting more money. And when you are drawing these profiles, this band which you are seeing is called the strike price. Okay. So anywhere you see this band which is called a strike price. If the price goes above, then the strike price, only then you will get this start making money. Okay. And as I said, the thin lines are immediate immediate profits or immediate what is the situation immediately. This is the boundaries that you can see. And as you go to the expiry, they merge to the dark line. And for a short one, let's say this is a short call. I have a question. Somebody can tell me what is the premium that I'm paying. And then what is the profit that you have for a short call? You have unlimited profits or limited profits or what?
In theory, the profit is unlimited, but as you said, the Nifty will not like show variation too much.
Mm-hmm. So the question I have is, is it your unlimited profit in the sense, okay, is it, are you bound by some profits or no? And then losses as well. Are you bound by some losses or not? Here you know already your premium is your loss. And here for a short call,
I think
profit that you made on the short call. That's it.
There is a boundary of the losses also.
Somebody has answered limited profit and unlimited loss. Yeah, Manish is right. And what is that limited profit that you will get, Manish?
A premium call.
Yes, exactly. So whatever the premium that you have paid, that is the maximum amount of money that you can make. If you have, if I've sold at Gale at 7 rupees, right? And either I can lose or I can make. When I'm making money, if I'm selling at 1 rupee, I'm making 6 rupees. And maximum that I can make is 0. If I can sell it 0. In the sense 0.05 value or let it expire. I don't care. When I expire, what NSE does is, okay, this guy has sold at 7 rupees. Now it is worthless, so I'll pay him 7 rupees. In the sense, you have negative, in the sense, he's buying back from you. You are buying back from him, let's say. You paid at 7 rupees and you bought it at 0 rupees. So he gives you all the money. So that's the maximum profit that you get. Okay. And yeah, 28. Okay. So here what we have is
Sir, what is a long call means you are going, what is the difference between long call and short call?
Okay. I will first explain what is long and short, and then we will talk about call and put. Call and put you already know. Okay. Right?
Yes. Yes.
Okay. Now let's discuss about what is long and what is short. Long is something that you are buying. Okay. And short is something that who is selling to you. Let's say you are making a long call for a Gale itself. You are buying at 7 rupees. And when you are buying, somebody is selling it, right? Who is that person who is selling it? That guy is shorting. He is shorting the call. And for him, the maximum profit would be 7 rupees in case it becomes worthless. And loss is unlimited. If unlimited in the sense, okay, that 7 rupees can go to 25 rupees. If it goes to 25 rupees, what happens is he sold you 7 rupees and he has to buy back. When he buys back, he has to buy back at 25 rupees. So somebody buying back at 25 and selling it for 7 rupees, what happens? The loss is 18 rupees. So he has to bear all the losses.
Got it, sir. Thank you. Got it.
Yeah. Okay. Where are we now? Okay, I think we have discussed this part. Let me go to same. Here, based on this, we can make some strategies actually, based on this information itself. And what are the things which are unknown here and what are the things which are known for us in this table? No, not about the long is buy or not. My question is, what are the things that you know, price or volatility or time or whatever it is.
We
So
know
Anand
price
explain.
and
Yeah, we know what?
Time we know.
Yeah.
we know the price, the time, and we can back calculate volatility.
Okay. Basically, what we unknown in the sense, the idea is we are not very clear about it. What may happen to the price, we don't know. What may happen to the volatility, we don't know. It keeps fluctuating much. And time is something which cannot fluctuate. As we discussed before, it's linear. We know what it is. The number of days we know today, it's 30 days to expiry. Tomorrow it will be 29, then 28. And the time is something that we cannot change anytime. Right? So it's a linear change, which we know. It's a known thing for us. The unknown thing that we have is price and volatility. Unknown thing in the sense that we have to calculate or we have to, that keeps changing. So using this information, we have to forecast, forecasting our price based on this price and volatility. So how do we learn how to predict the price? So learning to predict the prices normally can come from, doing technical analysis or fundamental analysis or things like that. So you need to have a technical view and you should understand the events that are happening and then what could be the outcome of such an event. In the budget, if they are going to propose that we are going to put so much budget for bio related stuff or something which is related to green stuff, then all these solar companies or these companies, those companies, which will, jump. Okay. I'm just giving an example. Just understanding an event. If there is a budget and you know some certain information is there, based on certain information, you should be able to predict something. This is just based on the event. But technical, if you know, you will learn how to put the candles and candle formation and you know the resistances, you know the trend lines, you know patterns, you know all those things. Then you would be able to predict the price targets much better than anyone. Okay. Anyone in the sense than normal fundamental guy. So this is one thing where people use their methods to first predict the prices for the current market price. So you use that information in the option. Okay. And the other one is IV. How can we forecast IV? So someone who has a good technical analysis on the IV charts also will have these resistance supports and all those things that they can do. But the part of the volatility one I can explain is, it always reverts to mean. Volatility is more like a storm. So when we have storms here, what happens to the storm after some time? What happens to a storm once you get a storm in your face? In 1 or 2 days, what happens?
Calm.
It's calm, right?
Yes.
Yeah. So even if there is a high volatility, what happens in few days? It will come back to normal, right? So
Other than the event time, it's always same volatility what is in the history.
yeah. So volatility will revert to mean. So there is a mean value which we can take over a period of time, and if it is quite high, then you know that if it is quite high, in few days it will return back. So I will use this information for myself, and I will try to put this in the calculation and see how I can get my option pricing in such a way that I can trade it and make most money out of it. Okay.
So it can
So
be reverted with a beta value of the stock.
not beta value of the stock, volatility.
But
will
it can be
revert,
related with the beta. What volatility comes with is denoted by beta value of the stock only. How much
I'm not talking
volatility
about
it
normal
is.
volatility. Let's say take VIX. Okay, you know VIX, right? Huh? Do you know VIX?
Yes, yes. It's an
Yeah. So
Indian index, right?
volatility index. Okay, VIX. VIX charts.
Can we trade VIX?
Now I'm just talking about okay. You can see the volatility is quite high here, 15, 14.5 something. And this is a place where somebody has tried to put he sold some options or something. He knows that there is a high volatility, the option premium is higher. So in few days what happened, from 15 it came to 11. So I'm not trading really VIX, I'm trading markets. Okay, here the option pricing at this value is quite high. If you are taking some of the index, stocks, you will find the values are quite high 4-5 days ago. And though the price is increasing, so the price is decrease. The price is increasing, let's say, but still what is happening is the volatility is coming down. So what happens is the option price is coming down. Okay, so I think this is something one can use. So this is what we can do. I mean, this is what you can get out of this volatility. I think I made myself clear, but if you have